Most traders are taught from their earliest exposure to the markets that volume equals power. The higher the volume, the greater the conviction. The greater the conviction, the safer the move. It sounds rational. It feels measurable. And because it seems to promise certainty in an uncertain environment, it becomes doctrine. The problem is that it's wrong, or, more precisely, it's incomplete. Richard Wyckoff understood this over a century ago, observing that the crowd's interpretation of volume was one of the market's most effective tools for deception. What appears as strength to the untrained eye often represents distribution by the strong, and what looks like weakness can be the quiet accumulation of control. When a new trader opens a chart and sees a price surge accompanied by towering volume bars, the emotional circuitry lights up. The pattern seems clear. Buyers are flooding in, and the breakout must be real. The trader imagines momentum, imagines being part of a powerful wave, imagines profit. But in Wyckoff's world, the tape is not an emotional mirror, it is a record of intention. Volume does not show excitement, it shows effort. And effort, by itself, means nothing unless it is weighed against result. Wyckoff would stand before his students and draw two simple lines on a board, one representing the amount of buying or selling, effort, the other representing how far price traveled, result. When these two moved in harmony, the market was healthy. When they diverged, when effort expanded but price failed to respond, he knew something invisible was happening beneath the surface. It was not the public acting then, but the composite operator, the unseen hand balancing the market for the next move. Consider a rally that extends several days, each bar accompanied by expanding volume and wider spreads. The novice celebrates the confirmation, but Wyckoff would lean closer and ask a different question. If effort is this great, why does the result begin to narrow? On the tape, he would note that price closes no higher despite more and more activity. To him, that was not momentum, it was resistance. Someone was selling into the public's enthusiasm. The market, like a sponge reaching saturation, could absorb no more. The opposite is also true. In the depths of decline, volume often surges on panic. The crowd sees only danger. But sometimes, as price approaches an old support, the bars grow wide, the closes firm, and the following sessions show reduced volume on tests lower. Wyckoff would see quiet strength, not weakness, the professionals taking all that fearful supply into strong hands. The crowd sells because of emotion. The composite man buys because of logic. The same data, viewed through different lenses, tells entirely opposite stories. This understanding changes the trader's emotional relationship with the chart. Instead of chasing the visible, the student of Wyckoff begins to listen for what the market is whispering underneath. He learns that heavy volume can represent exhaustion just as easily as expansion. He realizes that low volume after a decline may signify the drying up of supply, a prelude to strength. The shift from seeing volume as excitement to viewing it as language marks the first step from follower to observer. Wyckoff's approach was not mystical. It was empirical, drawn from decades of recording and annotating daily market behavior. He saw the tape as a living dialogue between the public and the professionals, between noise and intent. Each bar carried a message, but only when compared against its neighbor. Volume alone was meaningless, context gave it shape. High volume could be distribution or accumulation, climax or absorption. The trader's job was to interpret the relationship, not the number. This deeper reading creates a kind of stillness. The observer no longer reacts to spikes of activity as calls to action. He begins to ask, who benefits from this movement? If the market is rising and yet the volume swells disproportionately, perhaps the public has taken the bait. If price surges on low volume after a test, perhaps strength is being revealed quietly. Every interpretation becomes an inquiry into motive rather than a reaction to motion. The irony is that this detachment, this refusal to chase, is what allows the trader to act with confidence later. By resisting the urge to equate volume with strength, he sidesteps the emotional traps that consume the majority. Wyckoff taught that the market rewards those who think in opposites. When the public sees confirmation, the professional sees completion. When the public sees collapse, the professional sees preparation. Most traders want the comfort of obvious signals, Yet the market's true intentions are rarely obvious. The composite man, as Wyckoff called him, understands the crowd's belief in high-volume confirmation and uses it against them. He distributes stock into rising prices because he knows the masses will interpret his selling as strength. He absorbs shares during quiet periods because he knows silence will drive others away. Volume, therefore, is not the truth, it is the stage lighting. It can illuminate or conceal depending on where one stands. Understanding this illusion requires humility. It demands that traders release their need for certainty and accept that the market is not a simple equation of more volume equals more conviction. It is a psychological arena where effort and intention intertwine, where every bar is both signal and disguise. Wyckoff's genius lay in recognizing that the market speaks most clearly when it appears most confusing. In the chaos of expanding volume and volatile price, the crowd loses orientation, but the disciplined observer sees structure, cause, and purpose. When a trader finally grasps that volume's true meaning lies not in its magnitude but in its relationship to price behavior, something profound shifts. The charts no longer shout, they converse. Each surge becomes a question: what purpose does this serve? Each quiet phase becomes an answer waiting to be understood. The trader stops chasing activity and begins studying behavior, slowly developing the same calm perception that guided Wyckoff through decades of market cycles. From that calm comes the foundation of mastery, the understanding that the market's greatest truths hide in plain sight, visible only to those who refuse to interpret volume as noise or emotion. The illusion of strength fades, replaced by the logic of balance. In that silence, the trader begins to see the invisible hands at work, moving price not by chance, but by design. Richard Wyckoff built his entire understanding of market behavior upon a single immutable law: the relationship between effort and result. To him, this was not just a trading principle, but a law of natural balance, as consistent as gravity or cause and effect. In the market, effort is expressed through volume, while result manifests as the distance price travels. Every bar, every wave, every campaign between accumulation and distribution is bound by this interplay. When they move in harmony, the market is healthy and true. When they diverge, when effort and result contradict one another, deception is present, and someone is preparing for a shift in control. Wyckoff believed that volume alone told only half the story, just as price alone was an incomplete narrative. The true reading of the tape came from the marriage of both. When the two are compared, effort as the input, result as the outcome, the trader gains insight into the market's internal condition. A surge in volume should, under normal circumstances, produce an equally notable advance or decline. When it does not, the imbalance speaks louder than the bars themselves. The crowd sees activity. Wyckoff saw friction. He would often describe the market as a living organism responding to pressure. When buying effort increases and price responds smoothly, demand is in control. When effort increases but the result diminishes, something beneath the surface is absorbing that force. The analogy he often invoked was that of a strong man pushing a wall. The crowd admires the strength and applauds the effort, but Wyckoff looks at the wall. If the wall doesn't move, the strength is meaningless. So it is in the market. Tremendous volume without progress signals resistance. Heavy selling with little downward result suggests the presence of strong buying interest. The professional understands that imbalance is information. Effort and result, therefore, form a diagnostic tool. They reveal when the market's internal engine is losing efficiency, when the relationship between buyers and sellers is shifting. During accumulation, volume may expand on rallies and contract on reactions. The result corresponds to effort. But as the phase matures, effort begins to increase without equivalent progress. Supply begins to re-enter, and professionals test the market's readiness to move. To the untrained eye, it may appear as hesitation or random noise. To the Wyckoff student, it's a conversation between composite hands, probing, testing, adjusting inventory before markup. This same logic applies in distribution. Early in the phase, effort and result maintain harmony. Volume expands on advances, and price responds. But as the public joins, Effort begins to swell without result. The professionals, having accumulated earlier, start selling into the demand. The crowd interprets the high volume as confirmation. The composite man interprets it as opportunity. The tape begins to show wider bars with poor closes, a subtle imbalance between what is spent and what is gained. This contradiction between energy and motion is the quiet signature of change. Wyckoff taught that traders should read this law as they would a heartbeat. Regular rhythm indicates vitality. Irregular rhythm warns of stress. When price makes new highs but the result weakens relative to the prior swing, it suggests exhaustion. When declines show violent effort but diminishing result, it implies absorption. The market, like a body, expresses fatigue before it collapses or recovers. Those who can hear the rhythm of effort and result ahead of time position themselves where the next heartbeat will pulse strongest. To grasp this law requires more than chart study. It requires detachment from the drama of price. The observer must step back and read motion as a scientist, not as a participant. Effort and result are not judgments. They are measurements of cause and effect. The tape is indifferent to desire. It only records the truth of transaction. If effort expands and the market responds, the move has energy behind it. If effort expands and the market stalls, someone with deeper pockets is taking the other side. Every divergence becomes a whisper of intent, a faint outline of professional strategy hidden within the noise. For Wyckoff, this law was also moral. It reflected the universal principle of balance that every cause must yield a proportionate effect. When traders violated this principle by acting on emotion instead of observation, they fought natural law itself. He would remind his students that markets, like life, reward equilibrium. When emotion adds unnecessary effort without measured result, loss is inevitable. When discipline aligns action with outcome, success follows effortlessly. The beauty of the law of effort and result is its simplicity. It requires no indicators, no algorithms, no opinions. It asks only that the trader compare what was spent to what was gained. A wide price spread on low volume suggests little effort producing great result, a sign of strength. A narrow spread on heavy volume shows great effort, producing small result, a sign of opposition. These relationships, repeated across thousands of bars, form the rhythm of all market cycles. The tape becomes a breathing entity, inhaling and exhaling effort, and result in endless motion. Wyckoff's genius lay in reducing complexity to observation. He knew that the market structure was built not on randomness but on cause preceding effect. Every campaign begins with preparation. Accumulation builds the cause. Markup expresses the effect. Distribution forms a new cause. Markdown expresses the next effect. This cyclical dance is visible only through the law of effort and result. To study volume and price without acknowledging their relationship is to read half the sentence and assume the rest. When traders learn to see through this lens, they no longer chase bars or react to spikes. They begin to weigh movement as an equation. Every effort demands an answer. Every result reveals the quality of that effort. The crowd reads excitement. The professional reads equilibrium. The crowd hopes for direction. The professional measures conviction. Over time, the student realizes that the law is not about prediction, but recognition, seeing truth in the proportion between what is done and what is achieved. In the calm observation of effort and result, the trader acquires a new form of confidence, one rooted not in emotion but in evidence. The market no longer feels chaotic or unfair. It feels structured, logical, and just. There is a cause behind every move, and when that cause weakens, reversal is inevitable. Wyckoff's law offers not certainty but comprehension, the kind that transforms speculation into study and reaction into awareness. Through that awareness, the trader begins to see the market as Wyckoff did, not as a battlefield of noise, but as a living record of effort seeking its rightful result. In Wyckoff's world, strength rarely announces itself with noise. The market's most powerful movements often begin in silence, in those uneventful stretches when traders grow impatient and volume begins to fade. To the untrained observer, the quiet seems meaningless, a market that has lost direction or energy, but to Wyckoff, silence was language. He called this phase Absorption, a process through which professional money quietly absorbs the remaining supply before a significant advance. It is a subtle and deliberate act, masked beneath the market's calm surface, yet it carries the signature of preparation that precedes every major markup. Absorption begins after a phase of visible accumulation, once the composite operator has already taken substantial positions. At this stage, the professionals are not interested in drawing attention. They want to test the market's readiness for higher prices. They push the market upward slightly and watch how it responds. If selling pressure reappears, they absorb it again, patiently taking in what remains. Each reaction becomes smaller, each test weaker, until eventually the supply that once resisted the move has been neutralized. To the casual trader, it appears that the market is stuck. To Wyckoff, it is the final tightening of the spring. He would explain to his students that absorption is a psychological battle fought beneath the surface. The public, weary of inactivity, begins to lose faith. Those who bought early during the accumulation start to sell, convinced that the move is failing. Their exits provide the very liquidity professionals need to finish building positions. This quiet trading activity, characterized by narrowing ranges and moderate volume, represents the market's heartbeat, slowing before a surge. Each bar whispers intention, not the chaotic noise of the crowd, but the composed rhythm of accumulation reaching completion. Wyckoff compared absorption to a sponge soaking up the last drops of water. The sponge can only absorb when it has capacity, and once saturated, even a single drop will cause overflow. Similarly, when the market has fully absorbed the available supply, even a small increase in demand can trigger a rapid expansion in price. What appears as a sudden explosive breakout to most traders is, in truth, the visible consequence of weeks or months of invisible work. The effect may seem instant, but the cause has been long in the making. The professional understands that what moves the market is not sudden enthusiasm, but the absence of opposition. During absorption, volume behavior often confuses those who rely on simple interpretation. Many expect strength to be accompanied by increasing volume, yet Wyckoff observed the opposite. As the process continues, volume tends to contract even as price inches upward. This is not weakness but control. It signals that fewer sellers remain to challenge the advance. The composite man has achieved dominance, and the market no longer requires large effort to make progress. The law of effort and result remains intact. Less effort, greater result, a quiet revelation of hidden strength. To observe this stage properly, the trader must learn patience, a virtue often dismissed in the pursuit of fast results. Absorption teaches the art of waiting without doubt. The longer the market stays quiet, the more powerful the ensuing move is likely to be. Wyckoff would remind his students that professional accumulation is never rushed. It takes time to convince the public that nothing is happening, to dull their excitement and exhaust their interest. Once the crowd turns away, the professionals can complete their work undisturbed. When the final test produces little response, when the market seems lifeless, that is when life is about to return. This process mirrors the psychological preparation required of the trader. Just as the market must rid itself of weak supply, the trader must rid himself of impatience. Both are forms of absorption, one mechanical, one emotional. The market absorbs selling, the trader absorbs noise. In both cases, the outcome is clarity. The quiet phase is not an absence of opportunity, but the incubation of it. Those who can endure the stillness develop a perspective unavailable to the restless. They begin to see what Wyckoff saw, that control is exercised not in moments of excitement, but in moments of calm. The brilliance of absorption lies in its invisibility. It takes place in plain sight, yet only those trained to recognize its rhythm can appreciate its meaning. Each small rally that fails to collapse, each test that finds support at a slightly higher level, tells a story of strength gaining quiet authority. Price movement becomes smoother, reactions shorter, closes firmer. The market is no longer being tossed by emotion but guided by deliberate intent. When the final bit of supply is absorbed, resistance collapses not through force but through absence. For Wyckoff, this understanding was not merely technical but philosophical. It illustrated a universal truth that real power does not need to shout. Whether in markets or in human nature, strength concealed is strength multiplied. The composite man never seeks attention. He seeks control. He allows the crowd to believe the market is dead, so that he may own it completely when it awakens. To read absorption correctly, the trader must share this mindset, detached, observant, and patient enough to wait for confirmation without anticipation. The irony is that by the time the public finally notices the breakout, the professionals have already finished their work. The wide-range bar that excites the masses is simply the release of stored energy accumulated over weeks of quiet preparation. Those who studied the signs of absorption recognized it long before. They saw the harmony between decreasing effort and improving result, the gradual disappearance of selling, the subtle rise of confidence beneath apparent inactivity. They understood that the silence was not absence, it was intent maturing. Through this lens, the market transforms from a battlefield into a conversation. Every low-volume rise becomes a whisper of dominance. Every shallow pullback speaks of control. The trader who learns to hear these whispers stops reacting to every spike of activity and begins to anticipate the inevitable expansion that follows true absorption. He learns to recognize hidden strength, not by its noise, but by its calm, not by its urgency, but by its composure. In that quiet recognition lies the essence of Wyckoff's art, the ability to sense the unseen forces, preparing the next great movement, long before the crowd awakens to the sound of its own surprise. Every great deception in the market begins with a show of strength. The bars widen, the candles surge, and the crowd feels confirmed. What follows is not coincidence, but choreography, a deliberate orchestration by the composite man to use human emotion as fuel for his final act. Wyckoff understood that the market does not move against traders out of malice. It moves because their misunderstanding creates liquidity. The volume that excites them is the same volume that the professionals require to offload or reload positions. The illusion of strength is a mirror the market holds up to the crowd, and they rush toward it, blind to the trap forming in their reflection. An upthrust is the purest expression of this deception. It often appears at the end of a long advance when the market breaks above a previous resistance level. To the public, it looks like confirmation of a breakout, a clear signal that the trend is strong, but behind that apparent power lies quiet distribution. The composite man, fully aware of the crowd's conditioning, pushes prices just beyond the barrier to trigger their orders. New buyers rush in, short sellers cover, and the last of the demand floods the market. At that precise moment, the professionals begin to sell into it, unloading their inventory at premium prices. Volume explodes, but the result begins to falter. The effort is enormous, yet price fails to sustain the breakout. This divergence between energy and progress, this sudden loss of harmony between effort and result, is the telltale signature of the trap. Wyckoff would describe the upthrust as the market's final lie before truth returns. It is the breath before exhaustion, the last burst of effort that conceals the beginning of weakness. He taught his students to observe not the breakout itself, but what follows immediately after. If the advance stalls or reverses sharply on heavy volume, the meaning is clear. The professionals have completed their work. They have sold to those who believed they were buying strength. The beauty of this maneuver lies in its simplicity. It requires no secrecy, only understanding of human nature. Hope, greed, and the desire for confirmation do the rest. The buying climax operates on a similar principle but in a more dramatic form. It marks the final, emotional stage of a bull market when the public's participation reaches its peak. The crowd sees only opportunity, unaware that the composite man is already distributing into their enthusiasm. Volume soars to record highs, spreads widen, and volatility expands. Every newspaper headline praises the rally. Every trader wants to belong to it. Yet within that euphoria, Wyckoff saw fatigue. He noted that after the climax, price may still hold near the highs for a time, forming what he called an area of distribution. The professionals do not exit all at once. They sell gradually, allowing the market to absorb their supply before the decline begins. The public interprets this sideways movement as a healthy pause. They mistake the slowing advance for consolidation, not recognizing it as the quiet unwinding of control. Composite deception thrives on the crowd's need for validation. Every trader desires proof that they are right, and the market obliges by giving it temporarily. The breakout feels strong because it is designed to. The climax feels unstoppable because it must. These moments are not random. They are engineered through the orchestration of volume and sentiment. Wyckoff saw this pattern play out in every cycle. Accumulation disguised as weakness, distribution disguised as strength. What makes these traps so effective is that they exploit the same law that governs legitimate movement. Effort leads to result, until it doesn't. When that law breaks, the truth is revealed, but by then, the damage is done. Behind the curtain, the composite man operates with perfect composure. He does not rush, he does not argue with the market, and he never seeks confirmation from others. His purpose is balance, to buy from the fearful and sell to the hopeful. Every trap is a reflection of imbalance within the crowd. They crave direction, so he gives them one. They want excitement, so he supplies it. He allows them to see strength where there is distribution, because that is the only way he can complete his work. Without belief, there can be no liquidity. Without participation, there can be no deception. Wyckoff emphasized that reading these traps required emotional neutrality. The trader must learn to detach from the collective thrill that accompanies rising volume. It is not enough to see the upthrust or the climax. One must feel the tension within the tape. When effort expands but result shrinks, when price hesitates at the very point where it should accelerate, the tape is whispering dissent. In those moments, calm observation becomes the trader's greatest weapon. The crowd reads excitement. The Wyckoff student reads exhaustion. What makes these traps psychologically devastating is their timing. They occur precisely when the market seems most obvious, when every confirmation aligns, when even cautious traders begin to believe. The illusion of safety becomes the instrument of loss. Wyckoff called this the market's cruelty, but it is not cruelty at all. It is equilibrium restoring itself. The crowd buys what professionals sell because nature abhors imbalance. Just as water seeks its own level, price seeks value, and deception is merely the process by which it returns there. As the volume peaks and momentum stalls, the professional quietly steps aside. The crowd continues to buy for a few more bars, unaware that they are purchasing from the very hands that guided the rally. Then, almost imperceptibly, price begins to falter. A failed retest follows, volume contracts, and the descent begins. To most, it feels like betrayal. To Wyckoff, it is simply the market exhaling after a final, exaggerated breath. Every trap, every climax, every upthrust is a necessary part of the cycle, the completion of cause and the beginning of a new effect. Those who master this recognition begin to see the market's rhythm differently. They understand that deception is not chaos but design, that volume surges are not always signals of life but sometimes the spasms of exhaustion. The tape becomes less emotional, more human, a living conversation between confidence and control. In that understanding lies both caution and power. For the trader who sees through the illusion no longer fears the noise of volume. He knows that where the crowd sees strength, the professionals often see the end. The most persistent obstacle to trading mastery is not found on the charts but within the trader's own mind. Wyckoff observed that even when a chart lays bare the intentions of the composite man, most participants fail to act appropriately because they are blinded by hope. Hope, he taught, is one of the market's most effective deceptions. It convinces the trader that a failing trend will reverse, that a breakout will succeed, that logic will yield to desire. It is an invisible force, more powerful than volume, more compelling than patterns, and infinitely more dangerous than mere uncertainty. The psychological architecture of hope begins quietly. A trader sees a market decline, then a pause, then a small rally. The natural instinct is to believe in recovery. Emotion whispers, "This is the moment. This is my chance." Volume may already be signaling the truth, heavy effort with little result, a divergence that screams distribution or absorption, but hope acts as a filter. It transforms clear warnings into background noise, insisting on confirmation rather than observation. The trader convinces himself that this time will be different, that the market will bend to desire rather than discipline. Wyckoff recognized this tendency in countless traders. He saw individuals clinging to losing positions long after the composite man had completed distribution, watching rallies as proof of strength while ignoring the subtle exhaustion in the tape. Each spike in price becomes validation, each failed test ignored, until losses compound and confidence erodes. Hope distorts perception, turning weakness into opportunity, fatigue into potential. It blinds the eye to effort versus result, to the rhythm of accumulation and distribution, to the very signals that once promised clarity. Fear and greed accompany hope, forming a trio of vulnerabilities that the market exploits relentlessly. Fear convinces the trader to exit too early, while greed tempts him to chase peaks that are already traps. Hope, however, is the most insidious, because it encourages attachment. It tells the trader to hold, to wait, to believe, even when the evidence suggests surrender. The tape becomes a canvas upon which desire paints its illusions. Every bar is interpreted as potential vindication, every correction dismissed as temporary interference. The trader loses the ability to see the composite man's design, because he sees only what he wishes to see. Wyckoff taught that the antidote to hope is discipline, an internal observation that mirrors the detachment exercised when reading the tape. Just as the professional monitors effort versus result without emotion, the trader must monitor himself. Every impulse, every urge, every justification must be measured against reality rather than desire. The mind must be trained to respond to evidence, not imagination. This is not an exercise in cold logic alone. It is an exercise in humility. The market is always correct. The trader must learn to defer judgment, to respect the rhythm of the tape, and to recognize the consequences of emotional bias. Hope is most dangerous when it coincides with visible signs of exhaustion. A failed breakout or a temporary consolidation appears to the hopeful trader as a pause before triumph. Volume swells, price fluctuates, and the mind weaves a narrative of eventual success. Meanwhile, the composite man uses the trader's belief as fuel, distributing or accumulating quietly while the public clings to illusion. Each misstep reinforces the psychological trap. Confirmation bias strengthens hope, and hope reinforces misinterpretation. It becomes a self-perpetuating cycle, one that the untrained mind cannot escape without awareness. Recognition of this blind spot is transformative. When the trader can observe his own hope without surrendering to it, the market ceases to feel like a battlefield and becomes a source of insight. Patterns, volume divergences, and effort versus result imbalances regain their clarity. The trader begins to act, not out of desire but from comprehension, responding to signals rather than chasing fantasies. Decisions become deliberate rather than reactive. The tape is no longer a mirror for emotion but a guide for action. Wyckoff framed this as a moral, as well as a practical lesson. Hope untested by discipline is ruinous. It convinces the trader that logic is optional, that emotion is sufficient, that the market will conform to belief rather than evidence. By contrast, discipline grounded in observation creates freedom. When the mind releases hope, the trader sees the market as it is, not as he wishes it to be. Mistakes are still inevitable, but they are manageable. Losses become lessons rather than catastrophes. The trader gains control not over the market but over his own perception. Ultimately, hope against the tape is a test of character as much as skill. Wyckoff understood that mastery is not found in memorizing patterns or counting bars, but in aligning perception with reality. The trader must confront the urge to believe in what is false, to resist narratives imposed by emotion, and to act only when the evidence is undeniable. In doing so, he transforms from a participant in a chaotic theater into an observer of structure, a student of cause and effect, a reader of intent rather than noise. Through this introspective discipline, the trader develops resilience. He can endure pauses, withstand false breakouts, and navigate volatility without surrendering to hope. Where the untrained eye sees opportunity, he sees intention. Where the crowd anticipates triumph, he measures control. The market is no longer a source of fear or longing, but a mirror reflecting the trader's own awareness. This awareness is the bridge to mastery, a state where understanding, not hope, guides every decision, and where the subtle truths embedded in volume and price become as clear as the composite man intended. Mastery in the markets begins not with prediction, but with perception. Richard Wyckoff called this state of awareness the composite eye, a way of observing price and volume that transcends raw data and enters the realm of intent. To the untrained trader, charts are a collection of random numbers, erratic movements, and fleeting patterns. To the student of Wyckoff, each bar, each surge in volume, and each contraction carries a story, a narrative of accumulation, distribution, testing, and control. The composite eye is the lens through which these stories become coherent, revealing the invisible strategies of professional operators who guide the market's flow. At the heart of this perspective lies the recognition that volume is never neutral. It is an expression of effort, a measure of human intention, and a window into the alignment of cause and effect. Every action taken by the crowd or by the composite man leaves a signature, subtle but measurable. The rise in a price bar without corresponding volume tells one story. The expansion of effort without price movement tells another. Wyckoff trained his students to see these discrepancies as windows into the market's internal struggle, to understand that behind every apparent surge or stall lies a battle of supply and demand, orchestrated with intention. The composite eye is also a state of detachment. It requires the trader to set aside hope, fear, and ego, observing markets as a scientist observes phenomena. Emotional attachment distorts perception, turning clues into noise and deception into opportunity. By cultivating this detachment, the trader begins to read intent rather than reaction, motion rather than emotion. Volume surges no longer excite, but inform. Narrowing spreads no longer frustrate, but teach. Every fluctuation becomes a data point in the larger narrative, every effort measured against its result, every divergence a signpost of hidden activity. Wyckoff's genius was in teaching that the market's behavior is cyclical, that accumulation inevitably leads to markup, distribution to markdown, and each phase is preceded by tests of supply and demand. Through the composite eye, the trader can anticipate these transitions without assuming control over them. One observes the subtle cues, the quiet absorption before breakout, the last upthrust before reversal, the diminishing volume that signals exhaustion or strength. Each observation is a calibration, a mental alignment with the flow of professional activity. Over time, this perception becomes instinctive, as the trader begins to see patterns of intent rather than patterns of price alone. Applying this perspective requires both patience and discipline. It is not enough to recognize the signs of hidden strength or deceptive weakness. The trader must also resist acting prematurely. The composite eye reveals potential, not certainty. Even when volume signals absorption or distribution, the trader must wait for confirmation through consistent cause and effect relationships. Each bar is a test, each session an examination of the market's honesty. By respecting these principles, the trader reduces risk, aligns with professional intent, and positions himself to act when the balance of supply and demand clearly favors movement. The moral dimension of the composite eye cannot be understated. Wyckoff framed market observation as an exercise in humility, requiring acknowledgement of forces beyond personal control. The market does not conform to desire. It reflects collective action and calculated intent. Success comes not from dominance but from comprehension. A trader with the composite eye does not battle the tape. He studies it. He does not hope for confirmation. He measures it. He does not react to noise. He interprets signals. In doing so, he develops the clarity necessary to participate with discipline, to act when opportunity is aligned with strategy, and to avoid the pitfalls of emotion that ensnare the majority. Through the composite eye, the trader gains the ability to synthesize all prior lessons, the silent accumulation of absorption, the divergence of effort and result, the deceptive signals of upthrusts and climaxes, and the subtle psychological traps of hope and fear. Each observation reinforces the others, creating a mental map of the market structure that allows for informed anticipation. The bars, volume, and spread cease to be separate elements and become components of a single, intelligible story, the unfolding plan of the professionals guiding the market's flow. This lens transforms trading from a reactive endeavor into a disciplined study of intent. The trader begins to read the market as Wyckoff did, with patience, logic, and awareness. He sees where the crowd is acting out of emotion, where the composite man is acting with control, and where imbalance will inevitably resolve into movement. In essence, the composite eye trains the mind to see the invisible forces shaping price and volume, to detect preparation before execution, and to recognize opportunity not in chaotic surges, but in the quiet signals of intention. Ultimately, the composite eye is the culmination of all that Wyckoff taught: observation over conjecture, evidence over hope, discipline over impulse. It is the ability to read volume like a language, to perceive the motives that lie beneath the surface, and to align oneself with the flow of professional intent rather than the whims of the crowd. Through this clarity, the trader achieves a profound understanding of markets, gaining insight into both their structure and their human nature. Knowledge becomes anticipation, anticipation becomes action, and action, when guided by observation rather than desire, becomes mastery.